Okay, we're going to deal with three large assets that they like to test, this being one of them in accounts receivable. So I want you to take some notes. I'm going to walk you through lots of little examples, show you those T accounts again and how we know what moves in and out of the account, and some of the specialized topics that they like to test on an account receivable. We have accounts receivable because in accounting under revenue recognition, we record revenue when it's earned, not when we collect the money. Therefore, if we have customers who pay us after the earning process, we're going to have a receivable. And normally, we give people 30, 45, 60, whatever credit terms you have, we give them a period of time to pay. But one of the things I want to show you in your notes is this. We may offer, under accounts receivable, we may offer a discount. It might say something like this, 210, net 30. And the reason we're offering this discount is we're trying to entice our customers to pay us early. So we say, if you'll pay us within the first 10 days, we'll give you a 2% discount. After 10 days and up to 30, you have to pay the original amount. Okay? We don't give you anything off of that. Now, there are two ways that we can account for this. One is called the gross method, and one is called the net method. And by the way, when we turn the coin over and get to inventory and we do purchases, we're going to do the same two methods, but we're going to be the buyer instead of the seller. Now, the gross method says, listen, we're going to go ahead, and I'm going to keep our numbers fairly simple. We're going to say debit accounts receivable for $1,000 and credit sales for $1,000. We have a $1,000 sale with these credit terms. We record the receivable at its original gross amount because we don't know whether they'll take advantage of the discount or not. So let's do two what-ifs. What if they do pay and take advantage of the discount? 2% of $1,000 is $20. They'll deduct $20 from their balance and they'll send us a check for $980. I will have to wipe off the receivable for $1,000. And the $20 we'll call a sales discount. It will appear in the income statement right below sales as what we call a contra or negative sales account. It's not an expense. It's not a cost of doing business. We simply adjusted the selling price because you paid us early. I will show the original selling price less the discount. Net sales will be $980 so that management can see the amount of discounts that were taken. Or, here's the or that we'll have, or if they pay and don't take advantage of the discount, it's debit cash and credit accounts receivable for $1,000. There are your two possibilities. But in either case, we started by recording our receivable at a gross amount, and then we'll discount it otherwise. Now, I'll divide this, and we'll take a look. Parallel entries under the net method. That it says, you know, most of our customers take advantage of the discounts. So what I'm going to do is this. I'm going to record the receivable at its net of the discount amount and the sales at the net amount. Go ahead and just net it because they take the discount. Then when they pay and take the discount, this is the parallel entry here, I will say debit cash, $980, credit accounts receivable, $980. And the discount will not show up because I expect them to take advantage of the discount. So why mess with it? Everybody takes it. But what happens if they don't? And this is the or entry. Then you have something like this. You say debit cash for $1,000. Credit accounts receivable for $980. And this $20 is a discount forfeit, which is revenue to me. I'll put this as miscellaneous income, right? It's other income to me because they didn't take advantage of the discount. I made an extra $20. Now, what's the difference between the two methods? This method, the gross method, shows me the discounts taken, but it doesn't show me the discounts not taken. This method shows me the discounts not taken, but it doesn't tell me how much was taken. Why do we have two methods? Because it depends upon what you want to know, period. That's all it is. If you have a choice in management, which method would you like? All right? And they're the two methods. And as I said, we're going to see those methods paralleled when we go over to purchases because we can do the same thing. Second thing I want to talk about is this. Some types of companies sell but have a right of return policy. Okay? A college bookstore might do this where they say, we buy books from publishers to sell to students, but if we don't sell all the books, we reserve the right to return those for full credit. Well, do you really have a sale if there's a right of return? And the answer is, well, yeah and no. Now, what do I mean by yes and no? What we do is we say, if you can reasonably estimate a percent that is returned as the seller, you can recognize revenue for that net amount. But you must have an allowance that you cannot recognize as sales for what you expect to be returned, and then if it's not, then you can pick it up as income. But you must discount it. You must allow for the portion that normally is returned and not recognize that as revenue, because it would allow for great manipulation of income. I would just ship you tons of books and call it a sale, knowing you're going to send them back. All right? And I can deal with that later, in another period maybe. So we don't allow you to do that.